Hi, this is Lebogang Mokoena of Business Day Financial Mail. We're in Melrose Arch for the PwC Major Banks Analysis. I'm here with Stefan Beyers, partner at PwC. In the PwC report on major South African banks, impairments bottomed.
Yes, impairments bottomed in the period for which the report is comprised. That means that for the first time, we've seen the lowest impairment levels since we started the survey in 2009. The CEOs of the banks have said that they believe the credit cycle has bottomed out, which means that in future periods the impairment charge going through the income statement will increase.
What risks are South African banks facing in Africa?
They have different consumers and customers which have different demands to the local customers that they understand. They need to understand the risks that infrastructure poses. Political risks are different. At the same time, corporate governance standards may differ from country to country, and our banks need to understand the unique aspects of each country that they go into in order to prosper in those countries.
What is the short and long-term impacts of raised capital requirements of Basel III?
In terms of the short-term impact of the raised capital requirements, I think you'll see banks hold on to capital levels and wait until the requirements have settled, which therefore impacts return on equity levels as they hold higher capital. In the longer term, we still expect those capital levels to increase in the future. Stakeholders will have to get used to lower return on equity levels as banks are required to hold more capital.
How do South African banks rate against international counterparts?
The South African banks operate in a unique environment. They have risks specific to the South African environment, which they are well aware of and have been used to managing. In terms of expansion, the risks are similar to international counterparties. As they enter new markets, they need to understand new risks. Our banks have typically fared quite well in terms of return on equity levels when compared with international banks, as well as cost to income ratios when compared to their international peers.
What would you attribute the increase of corporate loans to?
Corporates are starting to borrow again as they have expansion strategies and seek to grow into new markets. The second large increase we've seen over the last year has come in the form of the renewable energy projects in South Africa, which all of our banks have taken major stakes in, or significant stakes in. And the third has come from loan growth on the African continent, which in particular has come from large infrastructure deals or oil and gas